Most people set up a bank account when they're young and then just leave it there. They never question whether the interest rate is competitive, whether the fees are reasonable, or whether a better option exists. And banks are in no rush to tell them. This video isn't about distrusting banks. They provide genuinely useful services. It's about understanding how the business model works, where the gaps are, and how to make sure those gaps aren't costing you money you don't realize you're losing. We're covering 4 areas: the savings rate gap that most account holders don't know about, how overdraft fees are structured and how to avoid them entirely, what credit card rewards actually cost and whether they work in your favor, and how to switch to better financial products without the hassle most people assume it involves. Your savings account is probably losing you money. If your emergency fund or savings is sitting in a traditional savings account at one of the major national banks, there's a good chance you're earning almost nothing on it. Here's the gap. Depending on how it's measured, the national average savings account rate sits somewhere between 0.38% APY, the FDIC's own published figure as of April 2026, and 0.6% APY based on Bankrate's broader survey of institutions. Either way, some of the largest banks in the country, including several with tens of millions of customers, pay as little as 0.01% APY on their standard savings accounts. At that rate, $10,000 earns about $1 in interest over an entire year. Meanwhile, top high-yield savings accounts, typically offered by online banks and credit unions, are currently offering rates around 4% or higher. On that same $10,000, that's roughly $400 per year for the exact same risk, the exact same FDIC insurance protection up to $250,000, and easy access to your money. The reason large traditional banks can maintain low rates on savings accounts is that most customers don't switch. Inertia is a powerful force. Many people aren't aware the gap exists, or they assume moving accounts is complicated. The banks benefit from this assumption. Opening a high-yield savings account is straightforward. Most require no minimum balance and no monthly fees, and transfers from your existing bank typically take 1 to 3 business days. The interest earned is taxable income, so you'll receive a 1099 INT form for your tax return. Beyond that, the account works the same way as any other savings account. It's worth noting that high-yield savings rates are variable. They move with the Federal Reserve's benchmark rate and can change at any time. They're not a guaranteed long-term rate. But for money that needs to stay accessible, an emergency fund, a near-term savings goal, earning 4% instead of 0.01% is not a minor detail. How overdraft fees are designed. And how to opt out. Overdraft fees are one of the most criticized practices in retail banking, and for good reason. Historically, banks have charged $25 to $35 each time a transaction processes with insufficient funds, sometimes triggering multiple fees in a single day on a gap of just a few dollars. There have been significant regulatory and competitive changes in recent years. Many banks have reduced overdraft fees or introduced grace amounts. Some now charge $0 or a reduced fee, particularly under regulatory pressure and competition from fee-free online banks. But many traditional banks still charge meaningful overdraft fees, and for low-balance customers, they can be disproportionately costly. The key thing most people don't know: the system is actually structured as an opt-in, not an opt-out. Under rules that have been in place in the U.S. since 2010, banks cannot automatically enroll you in overdraft coverage for debit card and ATM transactions. The default is that you are not enrolled, and they must get your affirmative consent before charging you fees. If you haven't opted in, a debit card or ATM transaction that would overdraw your account is simply declined, with no fee. If you have opted in and would prefer the hard stop, you can revoke that consent at any time by contacting your bank. One important limitation: this protection covers ATM withdrawals and one-time debit card transactions only. It does not apply to checks, recurring ACH payments, or automatic bill payments. banks can still charge overdraft fees on those transactions, regardless of your opt-in status. If you rely on auto pay for bills, keep that in mind. There are also practical alternatives that are worth knowing about. Linking a savings account to your checking account as a backup, or maintaining a small buffer balance as a personal rule. Some banks offer overdraft lines of credit at significantly lower cost than standard overdraft fees. The broader point is that overdraft fees are avoidable with a small amount of awareness. And if you're being charged them regularly, that's a signal to look closely at how your checking account is structured. What credit card rewards actually cost. Credit card rewards, cashback, points, miles, are genuinely valuable if used correctly. But it's worth understanding the full picture of how the system works, because the math isn't always in the cardholder's favor. Here's how the economics work. When you use a credit card, the card network charges the merchant a processing fee, typically around 1.5% to 3.5% of the transaction, depending on the card type. Premium rewards cards generally cost merchants more than basic cards. Merchants, particularly smaller ones, build these costs into their prices. So, to some degree, everyone pays slightly more for goods and services because of card processing fees, whether they use a card or not. The rewards you earn are funded primarily by these interchange fees and by interest charges from cardholders who carry a balance. If you pay your balance in full every month and earn 2% cashback, you're broadly capturing value that works in your favor. If you carry a balance at a 20% plus interest rate, the interest charge typically wipes out any rewards benefit quickly. At a 20% APR, carrying a $1,000 balance for a year costs roughly $200 in interest, far more than any rewards program returns on typical spending. This means the value of credit card rewards depends almost entirely on one behavior: paying the full balance every month. For people who do that consistently, rewards cards can be a straightforward financial benefit. For people who sometimes or regularly carry a balance, the math generally runs in the bank's favor. Annual fees are the other variable. Premium travel cards often charge $95 to $690 per year. Whether that's worth it depends on whether you actually use the benefits: lounge access, travel credits, insurance, enough to offset the fee. If you're paying for benefits you don't use, the card is costing you money despite the rewards. How to switch to better products without the hassle. The main reason people stay in financial products that aren't working for them, low-rate savings accounts, high-fee funds, cards with annual fees they don't use, is that switching feels complicated. In most cases, it's significantly simpler than people expect. Here's a practical framework for auditing your current financial products and switching where it makes sense. Savings accounts. Opening a new high-yield savings account online typically takes 10 to 15 minutes. Most require no minimum balance. Once open, you link your existing checking account and transfer funds, usually settling in 1 to 3 business days. There's no need to close your old account first, and no credit check is required. Investment accounts and funds. If you're in high-fee, actively managed funds inside a 401k, check whether your plan offers lower-cost index fund options. Most plans do. If you have a personal brokerage account, you can typically sell your current holdings and repurchase low-cost index funds directly, though you may trigger capital gains taxes on any profits. This is worth factoring in. In some cases, staying in a slightly higher fee fund is less expensive than the tax bill from switching. Consider speaking with a tax advisor before making large moves in a taxable account. Credit cards. If you have a card with an annual fee, you're not recouping in benefits, you have 2 options before canceling. First, call and ask to have the annual fee waived. Some issuers will do this, particularly for long-standing customers. Second, ask to be downgraded to a no-fee version of the same card, which preserves your credit history and available credit without the annual cost. Canceling a card outright can impact your credit score by reducing your available credit and potentially your average account age. Checking accounts. If you're frequently paying fees on a checking account, look at whether a fee-free online checking account meets your needs. Most offer FDIC protection, mobile deposit, and access to large ATM networks. The main trade-off is the absence of physical branches. The overall principle: most financial switching is a one-time action that takes less than an hour and produces ongoing benefit. The barrier is almost always perceived, not actual. Here's the summary. Your savings account is likely earning a fraction of what it could, and moving to a high-yield account takes about 15 minutes. Overdraft fees on debit and ATM transactions are avoidable. The default is that you're not enrolled, and if you've opted in, you can revoke that at any time. Just remember, the protection doesn't extend to checks or recurring payments. Credit card rewards work in your favor only if you pay your balance in full every month. Otherwise, the interest charges outweigh the benefits. And switching to better products is almost always simpler than people assume. One-time effort, ongoing return. Banks provide useful services. But they're businesses, and their incentive is not to proactively tell you when a better option exists. That's your job. This is general information, not personalized financial advice. Consider speaking with a licensed financial advisor for guidance tailored to your situation. Subscribe for more how-to videos.